Lance. It's a pleasure to see you today, and thank you so much for being available for this interview.
My pleasure. Thank you for having me.
What is the business of Holman Capital Corporation today?
So today we again finance the equipment, infrastructure, facility, and energy needs of state and local governments. Transaction sizes are as small as $250,000 up to $100 million. But most of our deals traffic in the $1 to $30 million range, with financing terms anywhere from 3 years out to 30 years, but most of our financings are 10 to 20 years. Our investors are primarily community banks that do not have a public finance department, and effectively we become their public finance department. We originate the transaction, we underwrite it, we price it, we document it, and then we assign our interest or co-invest in that loan alongside the community bank. And so we've been able to attract local capital here in California for local projects in California. And we do the same thing in Utah and Washington and Colorado. So we've expanded to a number of states.
Can you explain a little bit more the relationship between municipal bonds and the kinds of loans that you're making?
Yes, if you compare them side by side, the similarities are they both lend money to the government. They both finance the infrastructure. The differences are the players involved. In a municipal bond, you have a lot more people involved in the transaction. You have a rating agency, you have a trustee, you have an underwriter, you have ongoing disclosure, and you have a financial advisor. Well, that entire team of financing professionals has to be compensated. And so it comes out of the yield that the investor otherwise would have received. But if you do a loan, then you don't need a rating agency. You don't need a trustee, an underwriter, a financial advisor, and you can go direct, and the investor will now be able to get a higher yield. But in able to do that, you still need someone with the expertise and the relationships and the commitment to originate the transactions and properly underwrite them. And that is our role. So we are in the middle, acting as the guardian for the investor to search and underwrite and place those transactions for the investor.
Okay, well, let's go back into the investment a little further, because it's evident that you've identified a huge market and all these smaller municipalities that don't have enough critical mass to issue bonds on their own, and that they need to borrow. And they do have that natural monopoly to make the payments. So let's analyze the investment a little further. For the water treatment plant, what's the maturity of that loan going to be in that case? Is it 20 years or something else?
So that's part of our strategy. In a traditional bank, they would show a 30-year loan, and it'd be a fixed rate. So you have a fixed coupon for 30 years, and you'd have a 10-year no-call provision in that structure. In our strategy, we basically lock in the rates for 30 years if that's what they want, but then we also show them that they can lock in for 10 years at a time. And we reset the rate every 10 years. And by doing that, in general, you're going to cut the financing term down from 30 years to roughly 22 years. Now, the investor still gets a higher 10-year rate. And then at the end of 10 years, the rate resets. Rates have been pretty stable the last 10 years. So you should expect that the coupon should be consistent to what it was before, but there's no guarantees.
Do you think that this asset class will end up in the portfolios of wealthy individuals, or do you think that it naturally sits on a bank balance sheet long term?
The evolution of the business is to move from the bank balance sheet to a hybrid of also individual investors. So if you had a very wealthy investor who had $20 million to invest, then I would be happy to talk to them, because my deals are between, again, $1 to $30 million. So we could create a portfolio for them. But let's say you had an investor that had $5 million of discretionary capital. Then our next step is to create a fund for those investors. So instead of that investor putting their money in their checking account and getting zero, now they can get 2 to 4% tax-free by putting it into this loan and having those funds paid directly to their checking account.
And how long would I need to invest for before I would get my principal back in this type of investment?
It can be anywhere between 1 year to 30 years, but most of the transactions are between 10 to 20 years. But it pays like a mortgage on your home. And so you're going to get back half your principal in roughly 50% of the time. So you're looking at, if you do a 10-year deal, you're getting it back in 5 years. If you do a 20-year deal, you're getting it back in 10 years, half of the principal.
Interesting. So these are amortizing loans.
These are amortizing loans.
Okay, let's switch gears and go into risk for a minute. How do you assess risk, and what's the biggest risk with one of these loans?
So my investors primarily have been banks, and banks have the expertise to underwrite deals. They don't have the expertise to underwrite the public sector deal. And so we effectively train their bank credit officers on how to underwrite municipalities. And so that makes the process very fluid and efficient from us originating a deal, writing up the credit, preparing all the contracts, pricing the deal, and then having them verify everything that we've written. If you are setting up a fund, then you have to have another party affirm that the underwriting is correct. So we would then originate these deals, and the fund could have their own underwriters. If the investor wanted us to underwrite the deals, which we could, then we would partner with a community bank and sell half the deal to the community bank so they verified the underwriting. And then we sell the other half of the deal to the fund. And now we've got verification on the underwriting and verification on the pricing, because we have arm's length distance between us and one of the investors. And the price from the bank to the fund is exactly the same.
What is one of your favorite things about what you do and this investment that you're originating, if you think about it from the investor's perspective?
I believe that I am a very creative person. And when I left my job at the big bank, I felt liberated. But then when I started doing transactions and seeing the reaction from our community bank presidents, that's freedom. You can be even more creative and structure different types of transactions and bring a whole new source of capital and ideas to these small and medium-sized governments who normally don't get the attention. And as I mentioned before, they spend about $4 trillion. And can you imagine giving $4 trillion to a group of people that may not get the same attention that the city of Los Angeles gets? The city of Los Angeles is going to get a better transaction delivered to them. And if we can more efficiently deliver not only capital, but how to structure the deal, how to build the project, and how the overall cost and the value of it, that's what I call client satisfaction. And I just am inspired by that. I'm passionate about it. I wake up every day and I love my job. And I asked myself, if I could go and do something else, what would it be? And it would be what I'm doing today.
That is so wonderful, Lance. I'm very happy to hear that. And I understand what you're saying, because I've had that same observation where your clients appreciate what you do and you're part of getting something built that improves the neighborhood or improves the city or whatever it is. So I think that's one of the reasons that your message resonated so strongly with me. Lance, it's been a great pleasure talking to you. Thank you very much.
Thank you for having me.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.